Okay, so to trade the London session, we need to know where it actually is. I love using this indicator over here by Mr. Vida, sessions Asia, London, New York, and in the parameters you will see the remaining sessions. Make sure to close off the Asian and New York. The main focus today is the London session. So as you can see on the charts, you will have the London session marked quite clearly with the candlesticks, which is what we want. Now, there are two main ways to trade the London session, and I believe both of them are profitable. The first way is for day trading and scalping on the 15-minute chart. We will need 3 technical indicators, and all of them will be exponential moving averages. The first moving average will be period of 8, second period of 13, and the last moving average period of 21. So before you go crazy and start placing trades, you need to identify the overall market bias. So go out of the 15-minute time frame and have a look at the 4-hour. As we can see over here, it's trending up nicely, and the same thing is happening on the daily time frame, which is perfect. So we are trending currently towards the upside. That's the main time frame we actually need for 15-minute trading. Now, taking a look at the 15-minute time frame, we could potentially just enter on the session opening just over here. 8 in the morning, the London session opens, and 5 o'clock it closes. So if we open this trade, it would have been 20 pips profit, and 20 pips is the minimum we wanna take our profit in. If we don't get 20 pips, there's no point even to partial close. This trade failed. I wouldn't say this is the best entry, although I do like this candlestick over here. So maybe I would have entered, maybe not, but there's a better way. So if we play the market, and as we can see, it goes towards the upside. So now let's say we had that nice breakout towards the downside, right? We confirmed some bearish pressure. Okay, a pullback has happened. Where did it happen? To the previous area of sensitivity, just around here. This previous area level seems to have been respected now. It's going towards the upside. We wait for the moving average cross. Just over here, we would enter the trade. We would put our stop loss just a tiny bit lower than the previous area of support, and we would be aiming for 20 pips by the minimum. So obviously this is a great entry, and we would have banked 20 pips profit, but this is not where we should close our trading position. We can continue trading until it crosses the middle exponential moving average line, which is just around here. If a bearish candlestick doesn't close below it, then you keep the trade open and you maximize your trading gains. So this risk reward doesn't really matter because you're aiming for the minimum, but potentially you will maximize the trading gain. So let's see what would happen with this trade. And in this case, it actually does cross in around this area zone. So in this case, we would have banked 20 pips only. But I can assure you that other examples we're going to be looking at more than likely will have a much trading gain because the trend will continue. The exponential moving average will be respected, and you will see a much bigger trading gain. Okay, now let's take a look at another example. We have our entry over here, session opening time, nice little support through a consolidation, bullish engulfing candlestick crossing all 3 exponential moving averages just over here. We are aiming for 20 pips again for the minimum take profit level, and stop loss has to be just below the previous area of support, which would be in this case 31 pips. So in this case, it's not a great risk reward, right? But as I said, it doesn't really matter because that's not the true risk reward. We can change that. So let's see what happens with the market. So it continues moving towards the upside. So even if you got scared and closed off your trading position just around here, let's say we closed it at about 8 pips minus because it crossed the exponential moving averages, we can re-enter again just about here because it crossed back, right? I wouldn't even say that this is a cross, but let's say hypothetical, we lost 8 pips, now we re-enter, and there we go. Look, it's trending towards the upside nicely, and you can continue making money this way. You don't close off the trade until it crosses this middle line, right? The middle line was never crossed. So from 20 pips market gain, it becomes, 30, 40, 50, 60, 70, even 87 pips just over here. And it's attempting to cross. Let's see if it does. And it crosses just around here, or actually not. Let's see where it does it go. Yeah, it actually crosses. So around 87 pips to 72 pips. take profit level. Obviously, you could have just closed off at the end of the London session, which is around here, which is also 56 pips. But why not keep it running? If it's making you money and you know the strategy has not yet crossed the middle exponential line, there's no reason to close off your position early because you're maximizing your trading gain. So another example with a common mistake I see most traders make, they close their positions very early and they get scared when the candlestick hasn't yet actually closed. So here's a trade I would be taking. So let's say moving averages were here trending towards the downside. We crossed all three exponential moving averages with this bullish candlestick. We actually even passed the previous area of slight resistance that we had over here. Let's say we would be taking the 20 pips take profit, and let's say stop loss around here, just the low. We are covering the low in case it just dips down, because of course if you remember what the wick is, when the timer is ticking right on the 15-minute time frame, let's say there's 6 minutes left until the candlestick closes, it might even engulf the exponential moving averages and you might think, oh shit, it's crossing. But that's not the case, because you wait for the candlestick closure and it actually respects the exponential moving averages and closes above them. So if you close the trade, you would have lost this trading opportunity over here, which is a 20 pip beautiful gain in the market. And of course then it dips down and it actually closes below the exponential moving averages, which is where you can close off your trading position, you know, -2 pips, but that's fine because you partially closed 20 pip gain, which would have gave you a profit anyway. So now let's take a look at another example and another problem you may have. So we have our trade entry, resistance, support just over here. We are trending towards the upside still on the various time frames. 15-minute time frame seems to have now broken the previous area of resistance, right? More than likely we are aiming for 20 pips. So let's see what happens. And we do get that trade towards the downside, bank ourselves some profit. Now, in case it does this and it crosses the area zone, let's say because we wanted maybe to continue trading and we wanted to continue go up, we would close our position just around here. So 10 pips because it crossed all three exponential moving averages. So we won 20 partially and we lost 10 the full one, so we would be around break even at this point. So what can we do? Well, there's always a re-entry. You want to close off your trading positions and not be scared to close them up, because there's always a better re-entry and an opportunity awaiting for you. So what we can do is just wait and see what happens. It continues moving down, so ain't you glad we closed off this trading position? I sure would be. Then it continues moving up and let's see what happens. So a nice bullish engulfing candlestick just over here. Obviously this previous area of support becomes resistance, so we need to be careful of that. We might even have to have a look at the previous low just around here, so maybe even put your stop loss if you are considering to enter this trade. Maybe put your stop loss around 55 pips if you enter just over here, but you wait for better opportunities. Let's see what happens. So it does dip down as suggested, actually. That's funny. There we go, bullish engulfing candlestick. I really like this one. Why is this a great entry candlestick rather than these one over here? These were respecting the previous area of resistance, right? Support was over here, was broken, push exhaustion, resistance line. This resistance line has now been broken with this strong bullish engulfing candlestick. We can see it's making higher lows. This is perfect. We could enter our trade just over here, still covering this area zone, I would say, so 58 pips. The reason why you would have such a large stop loss is because of the volatility only. If it dips down like that, yes, you get stopped out if it hits it, right? But you want to ride the volatility. As you can see, this was a huge candlestick. You could have gotten, you know, stopped out. So you want to have the big volatility. But if the market is going to calm down and move normally, you will close off earlier if it breaks the exponential moving averages. That's where you actually close off the trade, not this one. This is a fake like stop loss, let's say. This is the only stop loss you would use in extreme situations if the market just continues dipping down in seconds. So let's see what happens. So we do manage to get our 20 pip partial profit, but can we get a little bit more? It continues moving up. once again. As you can see, the candlestick's never breaking the middle 13 exponential moving average, so you're riding the wave. Just over here around 50 pips, obviously you would find an area of resistance somewhere over here, so I would probably close off my trading position around here. But let's see what happens. It continues moving towards the upside a little bit more, so potentially you could have banked another 12 to 13 pips, and then eventually we do get that exponential moving average cross, which is where we would close off our trading position automatically, so around 40 pips. And you could have banked this trade easily using this logic, right? This stop loss is pretty much non-existent. The risk rewards are made up. You can have, this, you can have that. It doesn't matter. People overthink this way too much. The market is unpredictable. It can do anything. So that's why you want a big enough stop loss to ride the wave. But your main stop out position is when it crosses the exponential moving averages. So crosses here, you close, you bank profits. If it dips down, crosses the moving averages like we had over here, well, then we close our trading position. You will likely not have these sudden strong enough movements on pairs such as GBP USD, Euro USD, especially if there's no news around. But this comes to another topic, the macroeconomics, which you need to look out for, right? If there's going to be an interest rate decision or the non-farm payroll, then obviously maybe look out for that, because it could be very, very volatile. So another example, let's say we see this GBP USD going towards the upside, bullish engulfing candlestick. Is this a perfect entry? Well, it might be. We put our stop loss just around here, maybe just a little bit lower to cover this previous area wick. We are aiming for 20 pips once again. Let's see what happens, and it dips down. Where do you close off your trading position? Well, you obviously wouldn't close it for 25 pips stop loss. Why would you wait? You would close it straight away when it crosses the 3 exponential moving averages, which would be 7 pips in the minus. You close off early, you're not scared, you are waiting for re-entry and restabilization of the market. You don't want to be carrying this trade all the way down over here, because you will be panicking, you won't be in a good mood. You rather close it, wait for a re-entry, and then wait for a nice little trend to come up following the higher time frame bias. And that's the best way to trade the London session, I can guarantee it. So here's a good example. We are aiming for 20 pips, right? We would have this previous area zone over here marked. Stop loss, the made up stop loss would be here. Bullish engulfing candlestick crosses, goes towards the upside. We close our position just over here in the loss, because obviously it crosses back towards the downside. So we didn't catch this move. It's lame. 10 pips minus. Okay, fine. We wait for a re-entry. Where is the re-entry? A nice bullish engulfing candlestick just over here. Look, our stop loss is much lower this time, around 38. The made up stop loss, that is 20 pips we are taking. Boom, we cash out 20 pips. But the point is, you want to kind of trail your stop loss in a sense with the exponential moving averages. So over here, right, 20 pips. Where do we close? Well, it never closed above the middle line. I'll repeat it again and again. Look, so you guys understand, you could have banked yourself a nice 3-1 in this case. As I said, this stop loss doesn't matter. It was just for volatility. And there we go. We close our position just around here where it crosses the second exponential moving average, and there we go. Boom, 93 pips banked easily. With this strategy, you could have maximized even to 117 pips, and I would recommend, if you do ride this wave of around 117 pips, then maybe close off early. Don't be too greedy. Okay, now let's discuss the second way of how to trade the London session. And trust me, if you combine both of these ways, you're going to be a very, very profitable trader. I've been having a lot of success with this, and you guys should try this too. Okay, so for this method, we need GBP USD 1 hour time frame, and we need 2 moving averages, which is 20 and 50. Okay, so we have everything set up. We have a kind of an area of support just over here, stop loss just below it. A previous area of resistance, I would say it's a nice little consolidation, but it's above the 20 and 50 moving averages, and a nice bullish engulfing candlestick does confirm a trade that it should continue moving towards the upside, right? So what do? You wait until it actually does something. Let's say it goes towards the upside. Perfect. You partial close your trade, but then you come back to the 15-minute time frame and you swap your indicators. Close off 20 and 50, add on to the 8, 13 and 21 once again, and you ride the wave in the same directional bias. So what I did there is I confirmed on one time frame a buy entry, and then I confirmed the same thing yet again on the shorter time frame, which is the 15-minute, and we continue moving towards the upside, then we could have banked a ton of money just over here, around 84 pips, as you can see. Potentially you could have closed just around here because it did close, you know, below the 20 exponential moving average, right, just around here. So maybe you would have closed it, you know, with what it was. You kind of enter over here, let's say exponential moving averages going towards the upside, 47 pips or something like that. Close it over here, but what you can do is re-enter again, because you know the higher time frame bias is still bullish. You can re-enter again with a nice bullish engulfing candlestick, and then see what happens within the next couple of candlesticks. Maybe this one. If it continues dipping down, then you close off yet again. But if it continues moving up, potentially it would be retesting this area zone. As you can see, it broke it. That's perfect little scenario. We continue moving up. We can bank ourselves another 56 pips maximum until it actually does close off just over here, and then we stop. Could have failed around here as well. As you can see, let's say we mark, we close just around here, so maybe 22 pips, but then we re-enter and another candlestick kind of closes. If it closes below the 3, which it is at the moment, this is super indication that we should stop trading at the moment. I'm not sure what's going on. We need another confirmation. Redraw everything, redraw your trend line, support and resistance on higher, lower time frames as well. This is the simplified method, but essentially it works. And if you try this out, leave a comment down below. I can guarantee you will be a profitable Forex trader. I know people personally that trade this strategy only on GBP pairs, and they do really well for themselves. Obviously, an extra, always have a look at COT reports, economic calendars. These will enhance your trading as well. But if you really want to enhance your trading, you should watch this video next, because after 10 years of trading, I show you how I would learn Forex trading again from scratch.